Hello, I'm Nova Lui, RHB Bank's Head of Investor Advisory. Welcome to our monthly podcast. As of end of February, we have seen global market rout with S&P 500 down by 8.23% and Nasdaq down by 11.85%. While for investors who flee to more conservative assets, such as fixed income, are also feared by the impact of potential rate hike. There are many things happening in the market, including recent FOMC rate hike, the ongoing conflict between Russia and Ukraine. We would like to hear from Dr. Jha, Group Chief Economist and Head of Financial Market Research on these issues and the basis of his recent view to buy at dip. Meanwhile, Michael Chang, our CIO of Fixed Income from RHB Asset Management Malaysia, will share his thoughts on the rate hike prospect in Malaysia and some insight of bond investing in Malaysia to the larger extent of emerging market bond.
Hi, Dr. Jha. From your latest global and economic and market strategy, you have revised RHB's view on the potential FOMC rate hike. What is the latest view now, and may you share your thoughts for the reason for this revision?
Yep, absolutely. That's a great question. Okay, so we are now in terms of the federal funds rate by the end of this year at 1.75 to 2%, and we had been at 1% previously, and for end of 2023 we are at now 2.25 to 2.5% versus our earlier assessment of 1.5%. The Fed's revised dot plot as of March 17 suggests an end of federal funds rate median forecast of 1.75 to 2% and an end 2023 median forecast of 2.75 to 3%. We have revised also our terminal Fed funds rate to 2.5% versus our earlier assessment of 1.5 to 2%. So these material changes do not really impact, first of all, our forecast or assessment of where the markets are heading in the near term. The reason for our upward adjustment are mainly due to, first, that this time around at the March 17 FOMC meeting, at Chairman Powell's press conference, there was no hedging of bets by Chairman Powell that they would be raising interest policy rates significantly. There was no hedging. There was no if then that conditional on this, nothing at all, right? And basically, that's a big difference from the December and January FC meetings where they were essentially, giving all kinds of caveats that they would need to ensure and observe before moving more aggressively on basically monetary policy. That's the first point. The second point is that, relative to last time, right, that we had met a couple of weeks ago now, that we are observing that commodity prices are remaining at levels more elevated than what we had previously assumed. We think that the balance of risk is that oil price is consolidated, and with that, food comes down. But we have to be conversant, or cognizant that there are risks to upward pressures on commodity prices, despite our base case that we should see consolidation in the near term. And the third really is that when the central bank is guiding that it is going to do what it takes under inflation, you don't want to fight that central bank. In this case, it is the Fed. And these are the main reasons for our upward revisions to the Fed funds rate forecast.
Hi Michael, what about back to our home in Malaysia? How many rounds of rate hikes is expected in Malaysia this year, and the momentum of the interest rate hike? Will you be able to provide further insight on potential total rate hikes, say up to 3 years down the road?
In Malaysia, we may see 1 or 2 25 basis point increases in the overnight policy rate OPR this year, but timing would very much depend on how the Malaysian economy performs. Given there are new risks from the Russia-Ukraine crisis, global growth risks going lower in addition to supply constraints, This is in contrast to initial expectations, where the global economy is to recover when moving from the pandemic to endemic. Given these developments, there are only 4 remaining Monetary Policy Committee MPC meetings for 2022, of which 2 earlier meetings in January and March have left the OPR unchanged. Therefore, our base case this year is for 125 basis point increase unless normalization of interest rate path turns out to be more aggressive and a more hawkish US Fed in tackling inflation. We may then see a total of 50 basis points increase in OPR for 2022. To your following question, we believe the OPR would normalize to 3% gradually and over the next 3 years. It would be over a longer period than the previous path of interest rate normalization, i.e. during GFC, where we saw a 1% increase in OPR between 2010 to 2011. This round, we believe the increases will be staggered over a much longer period of time because the pandemic has far more implications than just financial. It has effects on social, health, infrastructure, etc., which has impacted Malaysia much more than the previous GFC. An OPR of 3% is also a long-term average for Malaysia, and since OPR was first introduced in 2004.
Based on the differences of the interest rate hike momentum between US comparing to Malaysia, do you see any inevitable outflow from the emerging market assets?
While Malaysia is part of emerging market or EM, we do not think we see a case of inevitable outflow of EM assets. Contrary, we may see some EM, for example like Malaysia, benefiting from the recent developments because of the realignment of risks within EM. Foreign investors may have revived interest in Malaysia given the current investment backdrop. The key positives for Malaysia are Malaysia's recovery should gain traction as concerns about the pandemic recede and virus containment measures are eased. This will underpin domestic demand. Soaring fuel and palm oil prices will also boost export receipts and government revenue. A fairly broad and mixed investor pool in Malaysia that invests in local denominated bonds with renewed participation of institutional flows in 2022. On interest rate differential, Malaysia's 10-year MGS still trades at 180 basis points against 10-year US Treasury and 80 basis points against 10-year China government bonds CGB. Malaysia's MGS yield beta against US Treasury is close to zero for year-to-date 2022, compared to the rest in the region and even outperformed China in this respect. A fairly stable foreign ownership of Malaysian government securities, where we are seeing year-on-year increase, especially in the Islamic government investment issue GII space, adds to this favor. Lastly, all these may translate into a more resilient Malaysian ringgit and with a better yield carry owning MGS.
All right, Dr. Jha. So, in fact, I have been hearing this view from you for quite a few times recently that you continue to make a call to buy at deep, especially starting from the quarter 2 2022, which is coming very, very soon. So, can you share with our audience again some of the key catalysts for the increase the exposure in the risky asset?
Sure. So the buy to dip on dips opportunity in the U.S., in India, parts of Southeast Asia is very close now. You know, we're already approaching the second quarter. Despite the rally in the Chinese equity markets, we continue to believe that China is a sell-on rally. You're better off, taking those losses or profits, whatever you've gained in China, and switching that over to another market, such as the Indian equity and bond markets. The key catalysts that we had been looking for the turn, in sustained turn, are basically are now coming to fruition. So the peak in terms of bearish sentiment is almost priced. I would say almost, not 100%. Nothing's 100% in life, as you know, Nova. But we're getting there in terms of market pricing in peak bearishness. And the things that we look at, for example, in terms of the equities world, it's fully priced. The three main risks. I've been speaking to clients over the last 2 to 3 weeks, whether it's institutional, whether it's essentially a high net worth, whether it's retail, and the themes are the same, or there's a common pattern. Let's just put it that way. Ukraine-related risk, stagflation risk, and essentially a Fed hawkishness risk. I start with the last one first because that's the easiest. Is that the market had fully priced in what the Fed guided 2 nights ago, right? In terms of the trajectory of rates that I've just mentioned to you, it's all in the price in terms of the U.S. bond market and rates market. In essentially in the equities world, we've already seen quite a bit of a significant sell-off in some geographies, bear markets, right? And in terms of equity risk premium in Southeast Asia and the U.S. and India, with that is looking fairly attractive. And then the third is that we think that the risks related to Ukraine are very much behind us, where our base case is that it will fade in the minds of investors in the second quarter of the year, simply because the Chinese and Indians will be helping Russia circumvent the variety of sanctions, whether it's on trade, whether it's on financial transactions, whether it's related to SWIFT, whether it's related to sanctions on the central bank, that's already ongoing, right? And the fourth then means that commodity prices, the flow of oil in the world, the flow of agriculture products, including wheat, which is a big commodity export of Russia and Ukraine, will continue, and supply in the oil sector is more likely to come from parts of Middle East, Latin America, creating a cap on oil prices in the $100 to $130 per barrel range as the peak. And we are not in the camp of some market participants suggesting $150, $200, $300. It could come, but not in 2022. And with that, it means then the stagflation risk are almost fully priced in the market by now, because inflation from our perspective in the US will peak in the first half, and in Southeast Asia, similarly, by the summer of this year, we should be at peak inflation. So all the peak bearishness indicators, we're basically closing in on that. We're just waiting for a couple things, right? One is that the next step in terms of gauging where the Fed is in terms of policy is on the balance sheet adjustment, where they will be giving the guidance at in the minutes of the March 17 FOMC meeting. The date of the release of this report is on April 7, so just about 3 weeks away. And also the dynamics of the China markets to ensure that continues to remain weak, but hopefully it doesn't transcend into sell-off in global in equity markets at the global level. These are basically the two main things, risk, that we're just watching closely, and hence the timing that is basically we're quite close now in terms of building those positions in terms of exposure to U.S., Southeast Asia, Indian equity markets.
Dr. Jha, can I just ask one more question about the Russian-Ukraine war? So I noticed that Ukraine has mentioned that they are not insisting for membership in NATO, and despite Ukraine has continued to ask for the support from the Western allies for military backup, but it seems like it's not happening. So can I safely say that we have passed the peak of this Russian-Ukraine war? What's your thought on this?
I mean, it's hard to say, because the issue at hand is that although that may be the case, but the sticker shock from the Western media cannot be ignored, right? Because to a certain extent, a lot of that is, a very personalized view of the Western world of the world at large. So it's hard to completely ignore that as it affects market sentiment. But the main things to focus on is the reason why markets will move forward or move past any sort of Ukraine conflict related risk is that the flow of trade from flow of commodities from Ukraine and Russia will continue. The Russian government this week on Wednesday fulfilled its bond obligations. They were due to pay $100+ million of coupon payments to investors. That has happened. That's a good thing. And basically, that the Russians continue to be able to engage in financial transactions with the help of the Chinese and Indians, so that Russia doesn't completely collapse. That's what that's what we are focusing on not necessarily just the headlines of what's going on in Ukraine. The only thing we're monitoring is hopefully the Russians, in our base case, don't move further westward, into other parts of Eastern Europe. In our base case, that's not going to happen. That's all we need to know, I think, and there's other issues of the sanctions being circumvented. That's what we're monitoring, and which is already happening, in fact.
Moving on to commodities, we noticed that gold has recently gained traction and oil price rallied 20% from the start of the year. Would you recommend clients to have some exposure in commodity, especially gold, in one's investment portfolio to hedge against inflation? And do you have any other suggestion beside gold, that any other alternative asset that can also hedge the portfolio volatility?
Yeah. So just to reiterate, since our last report on the 2022 outlook was published in December 2021, our global asset allocation has been and is maintained for the entire 2022 to be overweight equities and alternative assets, market weight fixed income, underweight cash. That's the strategy, right? Within that overweight, alternatives includes commodities, right? Any definition of alternative assets is commodities, right? And so we are, I would say we have been guiding that food and oil prices will remain resilient for quite some time, right? And so assets related to oil and food are the place to add exposure, and things like alternative currencies such as Bitcoin are areas to also add exposure to, property sector assets like REITs or physical property, other things in the alternative space. Gold is basically more tricky. We find that gold has lost its luster as a hedge against risk and inflation, and to some extent, other alternative assets such as oil, food, and commodity, metals, to some extent, have been far more, how should I put it, palatable in terms of hedging against inflation and risks events than gold. Even though we've seen gold rally towards 2000. But remember that the progression to 2000 or the eclipse of 2000 on an intraday trading basis has taken a long time. So it's not clear to me gold is the best place to do. You have other assets in the alternative space to add exposure to.
Talking about cushioning against market volatility, investors with lower risk appetite may continue to opt for fixed income investment. With the reopening of the economies in Malaysia versus last year, where Malaysia was affected by lockdown, what are the bond sectors in Malaysia should investors focus on?
This year in 2022, we believe investors could take a look at ringgit-denominated corporate bonds, given the reopening of sectors and in recent announcement that Malaysia will be reopening its international borders. We believe these steps will increase credit intermediation and higher demand for corporate bonds. Some of the sectors that could benefit would be financial institutions and banking, with the eventual increase in interest rate and hence profitability, and commodity-driven sectors that could be benefiting from increased prices of commodities. Notwithstanding, we still have a tactical allocation in government securities as this sector of the market because it could benefit from increased participation from offshore investors, although this development is still in the early stages based on our observations. Reallocation from an underweight on Russia and a less competitive yield environment in China government bonds versus MGS, we may see higher demand for MGS with these reweighting. The only risk for Malaysia is its fiscal deficit position, as Malaysia has fairly high government indebtedness arising from stimulus needed to tackle the pandemic, but is set to improve over time with the surge in prices over commodities and oil, which could provide some offsets to this risk.
Thank you very much to Dr. Sailesh Jha and Michael Chang. To all investors, we do not see Russian-Ukraine war as a black swan event in the near term, while policy moderation is on the plate as the global economy gradually recovers. Our house view remains as overweight in equity, neutral on fixed income, and underweight in cash for the remaining balance of the year. While investors are advised to look into opportunity to buy at dip in the global equity market. However, do it gradually as the situation may potentially turn well in the second quarter for this year. While for the conservative investor, it's important to continue maintaining your overall portfolio exposure in fixed income or any other more conservative asset. I hope to hear from you again soon in our next monthly podcast.